Welcome to the Without the Bank podcast, where you and I are going to talk about all things IBC, the business of banking, utilizing money correctly, and how this will help you grow your business and your wealth. Thank you so much for everybody that has left a review. I very much appreciate it. If you have not left a review and you would like to, I would appreciate that. And if you would share the concept, that would be awesome as well. Or share the podcast. Either one. I'm happy with either. Today, we are going to talk about what to do with that extra money you're putting to your mortgage. I have an existing client that called and said, Mary Jo, I am overpaying my mortgage. And I have run several spreadsheets to see how much money I should be putting into my life insurance policy or into a new life insurance policy, and then borrowing against that to pay down the mortgage. Because I really want my mortgage paid off by the time I am 55. Because at that point, that's when I can retire from my job. And I said, oh, okay. So we're overpaying on debt. And so let's talk about that for a minute. All of you people out there listening that are overpaying on debt. Now, some debt you might want to overpay on. So this doesn't mean everything. But if we are overpaying on a mortgage, that is 2.8% interest, okay? Interest rates are super low right now. And we're overpaying on that because emotionally, we want to have that mortgage gone, okay? Great, because we want to be debt-free. But guess what? The bum on the street is debt-free too. And he's begging for cash flow, right? He's out there with his sign asking for cash flow, but he doesn't have any debt, so kudos to him. So this client wants to hurry up and pay off his mortgage, so then when he retires, he won't have a mortgage payment. But guess what happens? If he takes all of his money today and he pays off his mortgage, he won't have that money today to start a business, to grow his business, to buy real estate, to do anything that could generate cash flow. So after retirement, he's not going to have any cash flow, but he's going to be debt-free. Kudos to him. That is this current so-called American dream, is to be debt-free, but then we wonder where our cash flow is going to come from so that we can live. Now, this guy is not going to retire at 55 years old. He is going to retire from the position that he's currently in. But at that time, because he's an electrician, he's working for somebody else as an electrician. But that doesn't mean that at 55 years old, he can't decide to go out on his own. Maybe he wants to do small electrical jobs. Maybe he wants to start his own business. He also farms. Maybe he wants to expand the farm. Maybe he wants to buy land. Maybe he wants to buy rental properties at 55. Or maybe we don't overpay on the mortgage and we use our money today so that we can buy rental properties today. We can expand our business today. We can start a business today. So that at 55, we have cash flow coming in and we don't have to worry about startup costs at that point. Everybody wants to get their debt paid for as quickly as they possibly can, but what they don't think about is what we're giving up. Now, this gentleman, Ash, also told me that he is doing private money lending at 15%. So he has a company that he gives money to. They lend it to people with terrible credit. And I don't know what they lend it to those people at, but obviously they make a small percentage, right? And they give him 15% return on it. So think about this. He has a 2.8% mortgage. So what is he doing? He's taking his money and putting it and paying off a 2.8% mortgage when he could be taking these exact same dollars, giving them to whoever is lending them, giving them to the lender, and then he makes 15%. Bridge loans, private lending, those are all things people talk about. Is there risk there? Oh, you betcha there's risk. There is no question that there is risk in what he's doing. But he is also the guy that had multiple spreadsheets trying to figure out what is the best way to pay down his mortgage. So I'm pretty sure he has done his due diligence, right? And he has lent a few dollars. So what has he done? He has borrowed against the life insurance he already has. He has borrowed against his cash value, and he has given it to the people that are lending it to other people and making 15% on it. So he's using his life insurance for that now, but he also wants to pay down a 2.8% mortgage because it feels warm and cozy. You know what's going to be warm and cozy? Having enough cash flow at 55, having enough cash flow at other times to start a business, to grow an operation, to grow a business, to do whatever it is you want to do, right? If he can make a 15% rate of return by lending money somewhere else and the return he's making inside the policy, why wouldn't you just start more policies and leave your 2.8% mortgage at the bank? Leverage their dollar just like you're leveraging the cash value in the policy. The only time, I shouldn't say the only time, one of the major times that I like people to pay down debt faster is if we have a 20% interest credit card. In the scenario of this existing client, I can go and start another whole life insurance policy. We can borrow against it. We're good. I do not, most of the time, I do not start a whole life policy when somebody has massive credit card debt and they have credit card debt at 20, 25, 30%, even 15% credit card debt. And if I direct those dollars into a life insurance policy first, I can't get that debt paid off as fast. That is very high interest. And credit card companies are compounding monthly, and we just don't ever really get anywhere with them. And so I like to get them paid off. And then when they're paid off, I like to be able to start an infinite banking policy. Now, I know that there are other practitioners out there that are not doing it that way, and I absolutely 100% do not agree with them. I am not going to mince words. It is one thing that I do not agree with my colleagues on because I don't see the point. Why would we strap somebody with debt longer than if you just paid it off? And then once it's paid off, you come to me and say, all right, Mary Jo, I'm ready to start a policy with the same dollars I was paying to the credit card company. Yes, we're going to have to wait to start that policy. But at the end of the day, what good are we doing by letting 12, 15, 20, 30% interest debt out there longer than we need to? Okay, some people are going to say that, well, it's because, they're never going to get started. This was the excuse I got. If you don't start them now, they're not going to get started. Well, guess what? If you don't pay your credit cards off to get started, it didn't mean you were serious to do this concept anyway. So I'm not so concerned about it. You would have probably not been a great banker to begin with, because this is what happens. And this is exactly what this client called for. He wants to take his overpayment, put it in a policy, then at the end of every year, borrow against that policy and pay down his mortgage. Well, now he has a policy loan that is charging him interest, and he has a mortgage that's still charging him interest and payments. And so he's going to have to pay interest in both spots. But what did he do? He took 3.8% interest and turned it to like 4.76, 5%, depending on the company. So we created more interest. Yes, we have control of it on the life insurance side, but we created a higher interest. Why not use that money to create cash flow? And then when we have enough cash value to pay off the mortgage, we do it in one fell swoop. We don't do it a small amount at a time because that house isn't creating us cash flow, right? That house is bad debt. Unless you are using your house to create cash flow, you have some sort of business you're generating out of it and you need it, and it's for some reason creating cash flow, then that's a different story. But most of the time, that is not the case. So having loans in two spots for a mortgage, to me, doesn't make any sense. Use the money for the next 11 years, because that's what he figured it was going to take, 11 and a half years or something. Use that money for the next 11 and a half years to generate cash flow. And then at year 11 and a half, we have enough cash value to pay off the bank. Either way, the bank is paid off. Either way, we're still going to have a life insurance policy that has to be paid back. But even at year 11 and a half, he may decide he doesn't want to pay off the bank, and that now we're at retirement. Now we want to travel. Now we want to start another business. Now we want to do X, Y, and Z. And we can do that because we have the liquid money, and we'll just keep the mortgage. I hope that helps answer some questions about overpaying on debt. And it doesn't just have to be a mortgage. It could be a vehicle. And, vehicle loan rates right now are 2% in some places. Like where I live, they're 2%. So if we can get a 2% loan rate on a vehicle, we may want to use the money in the policy to create cash flow. Cash flow is so super important. I don't care what you do in life, we have to generate cash flow. The podcast that I just had before this was talking about the fact that this is not a get-rich-quick scheme, right? That's what Nelson says in the introduction of his book. This is not a get-rich-quick scheme. Yet, we all think we're going to put money here and get rich and be able to retire. We can't retire if we don't put enough money here. And where do we get the money to put here? By creating cash from cash flow. Well, where do we create cash flow? Rental properties, businesses, right? We can't typically work for somebody and create enough income that we're going to have money for retirement. I don't care if you're doing some network marketing company, but if you own a business, that is going to be able to create cash flow. Are we going to sell the business? Those things are all going to be able to contribute to how much money we're going to have at retirement to be able to use this at that time. It's a big picture. But don't go overpaying debt when we can possibly better utilize that money by using it to start a policy, which then we get to use it for other things. Let me know if you still have questions on that. I hope that clarified a lot of stuff, because he had a really good question. And if he had that question, guess what? Other people have that exact same question. If you want to hear something and you have a topic you want addressed, please let me know, maryjo@withoutthebank.com. And I am absolutely happy to address that topic. If you have not gotten Life Without the Bank yet or Becoming Your Own Banker, go to withoutthebank.com and grab those two books, because they are going to explain more about this concept, what it is, why you want to use it, all that good stuff. And I require that you read one of those books before you meet with me. So once you have gotten those books, then we can set up an appointment. We can go over everything that you're doing and figure out, is it going to work for you? Is it a fit? Is it not a fit? I don't know. That's what we got to talk about. And believe me, I'm not going to sell you guys something, because I hate salesmen. Remember, I did a podcast on that too. Okay, let me know if there's anything you need. Otherwise, you have an absolutely fantastic rest of your day, and I'll talk to you in the next podcast.